Londra'dan herkese merhaba. Bugün Londra stüdyomuzda değerli bir yayın konuğumuz var. Mike Harris'le buluşuyoruz. Kendisi stratejist ve aynı zamanda Cribstone Stratejik Makro'nun kurucusu. Hi Mike, thanks for joining our program.
Hi Berfu, thanks for having me.
We are passing through an extraordinary time, actually. We have economic warfare, military conflict, trade tensions, and everything. How do you assess the global markets so far?
I think they're very confused, and it feels as if the market lacks clear direction, and it's a very risky period. Not just because of some of the things you mentioned, but also the conundrum of how AI is driving productivity gains, which are hurting jobs at a time of demand strength. This is a unique historic environment where central banks do not know how to read the signals of the market because job weakness and demand weakness are no longer aligned.
Mm-hmm. Actually, despite the Iran war, it was like a blanket covering all the bad things under the equity markets. So equities did well. Mm-hmm. So what do you expect from now on in the autumn period as we are, watching critical IPOs as well?
Well, I think clearly the bigger issue right now is the bond market. We cannot have this disconnect. The Treasury being forced to try and beat the markets in a game of chicken, in a sense, in terms of bringing the long bond down. That only works for as long as the Fed doesn't lose its credibility. And the Fed basically restoring its credibility. And I say that it's not lost its credibility, but people are having doubts about the ideology of the Fed. The Fed is no longer a simple beast that says, I want both maximum employment and lower inflation. It has an ideological agenda, and that is complicating the situation. And when there's so much alignment between the Treasury and the Fed in terms of that ideology, the markets know that ultimately they're going to win. Mm-hmm. And so it's a question of does the Fed acknowledge this? Or at a certain stage, do we have a proper battle between the markets and the Fed?
Do you think is there room for Fed to hike the rates? And is it important I know it's important for emerging markets, but is it important for countries like Turkey, for example, because they have their own story, own agenda and everything? What Fed does in the world, do you think it will affect immediately to Turkish markets, for example?
Well, I think it's less about the move than it is the conviction of global investors that this Fed is going to long-term anchor inflation expectations. And if it's less about whether they hike or whether they cut shorter term. Now, Turkey's beating a bit to its own drum. So, if the global, let's say, market chaos is never good for emerging markets and historically not good for Turkey. But if that happens at the same time the dollar is weakening, because the chaos might, if it happens, will be driven by a loss of confidence in the U.S. Treasury market. Hopefully that doesn't happen. It could be catastrophic. But ironically, the biggest issue in Turkey is the dollar rate and fear of dollarization. So if the dollar decides to weaken, and even if markets are poor, that could still play into not the Turkish equity narrative, but it could play into the Turkish fixed income carry trade / currency narrative.
Mm-hmm. Because many say that as there are less foreign investors in Turkey, what's happening in the international markets doesn't, affect directly as it is in the past in the Turkish markets. Do you agree?
Totally. The domestic investor is much more important, but we shouldn't take it for granted that the domestic investor is very more resilient than the foreign investor. But at a certain stage, if policy action in Turkey provokes a loss of confidence of the domestic investor, remember what we saw before the KKM deposit scheme was introduced. There was no floor for the currency because there was a loss of confidence. So this is a period where Turkey is less concerned with what happens internationally, but it is more vulnerable than it's ever been.
Mm-hmm. We'll come to Turkish markets, but do you expect a chaos in international markets, in the long-term bonds, in equities, in US, for example?
Well, the problem is you have two hedge fund guys basically are the most important policy actors in the US and arguably the world right now, and they believe they're smarter than the markets. And they're behaving as if they're smarter than the markets, and they're not. Okay, so there also is an element of misalignment because Warsh constantly pled, we're going to shrink the Fed balance sheet. We need less intervention. Now you have the Treasury, intervening. So there's the conflict of a politicized Fed, which is a huge risk. I mean, it's not happening. Thankfully, Lisa Cook hasn't been fired. That hasn't opened the door for Trump to pack the Fed. So Warsh does not control the Fed. But his focus on not communicate the forward guidance effectively. He still needs to communicate better, because there is a strong argument that actually the Fed should not be hiking because job destruction is happening. It's being masked by the fact that we're seeing productivity growth is clearly an outcome associated with these job losses. Again, it's not job losses in the U.S. driven by weak demand. Mm-hmm. And also, I think it's very important to note that because this is helping corporate profitability, these productivity gains, the wage policy of everyone who keeps their job is actually quite strong. So the weakness in the job market is not dragging wages down, except for maybe entry level. But even there, companies are doing well. So they're not pushing wages down. So there's this, he could make us, I think, a strong argument that, look, this is a temporary phenomenon, but ultimately AI is deflationary and job destructive. But ironically, for a man who doesn't want to give forward guidance, this requires much better communication, because it's not a typical market reaction, and he has to explain better his thought process and to make it very, very clear that this is what we're expecting. This is the data that supports it. These are the proof points we're looking at. And if anything tells us we're wrong, we will recalibrate. We're totally committed to 2% inflation. But what we don't want to do is make a mistake of hiking at the time so many jobs are at risk, and then risking a recession, because we're ultimately, if we had tighter fiscal, then we'd know there would be some fiscal recovery to help us out of that recession. But then we're going to be the only game in town if we're so fiscally prolific as we are in the U.S. right now. And unless we've hiked a lot, that allows us to cut. But hiking could itself exacerbate what could be quite a deep recession. So if I were him, I would be spending much more time trying to educate the markets about his thought process, as opposed to creating this element of opaqueness that's costing him and the U.S. Quite dearly right now, I would say.
I'm asking this according to your experience. I mean, are you more pessimistic or optimistic about the international markets?
More pessimistic, I think, without a doubt, because the impact of AI is sending these two conflicting messages, and you need actually incredible stewardship of the economy right now. And when you have someone like Trump who has a view on everything the Fed does, when you have a Fed governor who's promised low rates, and it sounds like for political reasons, as opposed to really articulating why they're actually for economic reasons, and when you have a Treasury Secretary who's confusing the situation and acting independently or seemingly independently, this ideological mix is, if this were happening in Turkey, the markets would punish Turkey almost immediately, and then we'd recalibrate. This punishment could take a long period of time that could end up being economically quite costly.
When it is U.S. So we have talked a little bit, but let me ask it in another way. If things go badly in the international markets, do you think Turkey is prepared in terms of central bank, in terms of Treasury and everything? Because we have seen some normalization in the funding rate. Some say that this is early. Some say that it is timely. What do you say, and what do you expect in the ultimate periods for Turkish markets?
Well, Turkey is cyclically done a lot of things to keep stability, but this is buying time. Structurally, Turkey is moving backwards quite aggressively. And this is very, very costly long term. You have this is a time when there are huge shifts in global investment, and the real appreciation of the Turkish lira is creating a manufacturing recession, jobs recession in the industrial sector, undoubtedly. And that's not good for Turkey, and it's happening for short-term political gain. It's not happening because a strong currency is the right policy choice. Needing a strong currency is a sign of economic weakness and economic policy failure. So we should never, even if there's a good outcome for Turkey associated with the scenario you just painted, we should always appreciate that the economic policy choices of the past many years have been disastrous for the long-term economic outlook for Turkey. Period. No one can argue with that. So as we move forward, if the dollar weakens it because the U.S. bonds sell off, that's terrible for markets. But it might be okay for Turkey because the dollar is really the only thing that's been the focus of economic policy for quite a long time, again, for political reasons. But what happens if the Treasury bond weakness weirdly or some sort of chaos in markets leads to a flight to quality that still drives the dollar higher, or drives all emerging market currencies, and Turkish lira sells off in sympathy with that. This central bank does not have a lot of room should we see pressure on the lira associated with just dollar moves. So dollar appreciation, they're basically leaving themselves vulnerable to things that happen externally because the policy mix has been poor. The disinflation program in Turkey's done. We know that because wages went up 30% in January. They're not going up now. That's economically painful, and inflation is not going to rise because people don't have money. But it's not going to fall because we know wages are going to go up again 25 to 30% in January. This is wage push inflation. It has been all the way since 2022, when Erdogan just went wages just to win the election. And we're suffering the consequence of this, of the lack of growth, constant inflation, stagnancy, but most importantly, this structural weakness of the manufacturing sector, because this real currency appreciation is costing the economy dearly. In the U.S., we went many, many years with the currency being stronger than and manufacturing being gutted, partially because of globalization, but partially because the U.S. had the exorbitant privilege of everyone wanting to own treasuries. But the end result was political change that's been quite extreme, and that is something that Turkey's sort of going through right now. Because of politics, the currency is being kept way, way too strong because of all this wage growth. They don't have the luxury of a devaluation, so we're going to suffer. Turkey is missing a window. In the early 2000s, Turkey captured the window to become an auto hub, right? Something was happening. Europe was outsourcing more and more of its auto industry. Turkey was exceptionally positioned, a very dynamic, strong economy, capable of capturing that demand. It did. Turkey's not capturing anything right now. And so if it adds pressure beyond just a lack of confidence that restricts the willingness to invest in Turkey, but you also exacerbate it with real currency appreciation, I think it's very predictable that Turkey is going to have many, many years of underwhelming economic growth because of the policy choices of these past few years.
I think we are coming towards the end. Last question. Under the calm international markets condition, in the remaining three meetings, is there a room for rate cuts, and what will happen to dollarization if there are rate cuts?
Well, so there is only room for rate cuts if there's no risk of dollarization. So they're not going to cut if they sense a risk of dollarization. So let's assume rate cuts can happen because of the domestic inflationary trajectory. Turkish inflation is really not going to go higher because people don't have money, right? There were no wage increases in July not just the minimum wage, across the economy. This is a very difficult period. There's no demand-driven inflationary pressure. It's wage-driven inflationary pressure. We had a 30% wage increase at the beginning of the year. It filters through. But the idea of inflation ending up higher than 30% just because interest rates get cut, I don't see it. An interest rate cut or two is not going to lead the economy and credit to soar. So we're not talking about stimulus. We're talking about, do they have the capacity to lower rates to a more neutral level? Yes, if there's no dollarization risk. No, if there is dollarization risk. This is less an inflation story now. If inflation was falling, they'd have plenty of room to cut, but there hasn't been the political willingness to take the painful decisions to continue with the disinflationary program. And also, if you disinflate and people aren't optimistic and aren't investing in supply, it's tough to do that. So this has been disinflation in Turkey is very difficult to achieve unless you have investment in automation and productivity and supply. And that, unfortunately, is not happening right now. So Turkey's stuck in the 25 to 30% inflation for the foreseeable future. I think we always should think about interest rates relative to that range. If they get too close to 25 to 30, what am I getting paid for? You risk dollarization from a domestic audience. So I don't see rate cuts driving dollarization, but at a certain stage, rate cuts will cause domestic depositors to say, well, what am I holding Turkish lira for? So they have to be careful.
Mike Harris, thanks for joining our program.
Thank you for having me.